Hello, hello. So today's chapter is about backtesting. I wrote these a little while back, so this one might be a little bit more brutal. Okay, little mosquito. This one might be a little bit more brutal than what truly is about backtesting, but truly a lot of people pray about their backtesting quite a lot, and yeah, this is one of those things that don't fully always agree with, but I actually somewhat do because if you just go onto TradingView during the weekends and you backtest somewhat, or you do instant replay, and then you can also start learning really cool things. TJ Artist posted a really good video on the poof, on how TradingView works, like measuring out how the charts kind of would look like. And if you do that enough, and you just go back months and months, and then you just put on like like a blindfold, and you look at the market, and you just draw it out every single time how the market will look, and you somehow get super good at it, and then you start doing it from that day with real time, and you start practicing that, and like a few months from now, if you're amazingly good at it somehow without even having any information on what is exactly going to happen due to news, due to this and due to that, you can kind of think in the future like, okay, maybe the Iran war is fully done. Maybe this and this and this and this happens. So if you then do something like that, it could be pretty crazy to start learning in those kind of ways because, yeah, if it works out, it works out. Those are kind of skills you want to have as a trader, trying to have that perfect predictability and probability. Like, if the market, in theory, crosses through this line and it will look like this, or if it crosses through this line and it will look like that, or maybe it's a fake out and it goes like this or that on this and this and this. XABCD patterns, good old any of those things, good triangle patterns, or general things in those ways. And you keep structuring those out, and over time you learn, you learn, you learn, and you create your own asset out of yourself to be the best trader you can possibly be. It's one of the big things. So backtesting is respect. If you haven't tested it, you don't trust it, and you shouldn't. Sometimes you get into the market, and it's not like you have to have backtested proof upon, like, the greatest pattern everybody loves lately is IFVG. So you need somewhat of an exhaustion into an IFVG, into a reversal over the VWAP. That's one of those patterns that like Lux Algo shows is so good. Or like I mean, that's one of the greatest things that most people like really have been digging lately. So that's a good one, for example. Or just generally when you're in the market and you just backtest for like just general knowledge of like seeing what exactly is happening in the market at this exact second. So say there's enough volume in it, there's enough buying power, there's enough active active volume plus liquidity from beforehand that's laying at a higher level. It wants to revert. It has all those things. Those are then signs that you can also just back test your own psychology, just like a test or exam. If you get a question in front of you that says A, B, C, D, um, would you go up or down right now or something like that? Or the answer is just stay out, be patient, and D would be all of the above. Which one would you pick in that second? And if you do that test often enough, and sometimes you're correct, sometimes it actually can be the opposite answer, and that's why the problem with trading is it's not perfect. But a lot of the times there are patterns that do repeat. Some rhyme, some repeat. So yeah, just be careful with which one it is. And if you can get quick trades in and out just by learning over time, that's one of the biggest things one can do. So confidence must be earned. Belief without data is gambling. Respect for risk starts with testing. Backtesting reveals truth. This chapter replaces hope with evidence. This one begins with validation. Why this chapter matters. Most traders never test their ideas. Losses feel personal without data. That's a huge one. Backtesting defines expectancy. This chapter builds real confidence. Professionals require proof. Certain patterns, like the one I was talking about the IFBG, or like certain trades with order blocks. Order blocks that just fail, or breaker that turn into breaker blocks, or order blocks that stay strong, which is another chapter that's coming up, would be those kind of things too, where the market then all of a sudden reverts or it doesn't revert due to those exact things that I just mentioning. So that's a good pattern or strategy as well. Backtesting those can work. Bollinger Bands, random strategy. The market just goes and is oversold, overbought for the RSI and the 15-minute chart. And all of a sudden, when it pops over the second 25 standard deviation 3 Bollinger Bands, 15 minutes, 86% win rate, and then goes too far into RSI. It first comes back 20 points, 30 points. You get your 30 points, that's $600, and bada bing, bada boom, kind of pretty chill, depending on how many contracts you put in. So stuff like that all work. Those easy strategies, 85%, but then the problem is what is your risk to reward in those ones? If it's that good of 86%, kind of plays in those kind of ways. And there's only so many times that it actually completely occurs. But those are fine things too. With backtesting, just go into PineScript, go with Claude, go with TradingView, go with ChatGPT, PineScript editor, run it, run it, run it until you find something great. Find strategy unlocks Algo, great one as well. Or in the near future, maybe Stellar Trail. We'll see what happens. Backtesting is historical validation. Past date is used to this past data is used to test rules. The results reveal strengths and weaknesses. Oh, quick second here. Probability is measured, not assumed. Outcomes are aggregated. Individual trades become irrelevant. Process becomes measurable. Why backtesting builds trust. Data replaces belief, loss becomes expected, variance becomes normal, draws are understood, confidence increases under pressure, discipline improves execution, emotions decrease. It's a huge one too because a lot of bigger firms they're using a lot more algos and stuff like that. So once you backtest a strategy, you slowly actually don't have to sit in front of your laptop anymore. And if you just want to make trading a side hustle, all you have to do is run an Apple Mini thingy with Claude and let him just trade your money with these kind of things and have a perfect execution every single time with the right stop loss and take profit. And from there, you hopefully get a lot of success and you don't really have to do anything with it. Sample sizes are misleading. One trade proves nothing. 10 trades prove little. Hundreds reveal behavior. Thousands reveal truth. Consistency requires volume. Patience is required. Expectancy, the core metric. Expectancy measures long-term outcomes. Win rate alone is meaningless. Risk to reward defines profitability. Loss are part of expectancy. Positive expectancy creates edge. Negative expectancy guarantees failure. Math replaces emotions. Win rate versus risk to reward. High win rate does not equal probability. Low win rate can still be profitable. Risk to reward defines leverage. The balance is required. Strategy design determines profile. And that's kind of the thing about the entire profile, what you really want to make yourself to be as a trader. And that's one of the biggest ones. If you can truly do anything to become a successful trader, and the 1% they're not doing the exact same thing as every single other one. They actually switch up things here and there. Maybe they have more insider information. Maybe this and this and this and this adds up. Maybe some of them are super, super lucky and they get into the market every single time. And when they see the market, they kind of are target maxing or so in those ways as well. Or they just don't use their frontal lobes to remember anything from the past, but rather to say, okay, that's the perfect pattern. We'll just run with it. I don't feel any worrisome aspects here when I'm playing for a little bit more money or so. And you just go with the strategy. And if it doesn't go your way, didn't go your way. On to the next day. Numbers matter more than feelings. Forward versus backward testing. Backtesting validates logic. Forward testing validates execution. Simulation tests discipline. Live trading tests psychology. Each phase has purpose. Skipping steps increases risk. And progression builds confidence. So that's one of the huge ones as well. If you want to be a successful trader, you should actually stick to certain things. A lot of times people say, the reason why we don't get to those successes in certain ways is because we're not always given all the exact same informations as other individuals have, or maybe they're leaving out a certain thing here and there. It truly is putting in the hours, journaling, doing the small things here and there, figuring out what exactly is wrong with what you exactly did, not getting lost in the track, not listening too much to the stuff about strategies and back testing and all those things, just going into anything, just like a attempted idea of creating a system, right? It takes you 6 months to create that perfect system. But during those 6 months, if you're kind of active with it and you're looking at it, and it can't just be paper money, but actually playing a little bit around with it, It's just like getting better at basketball or so. The dude that has 6 months of practice is probably going to be better than the guy that's just getting tossed the ball into his hands. But then you also have the idea of like Doncic or so, or like Jokic. I think the 6 foot dude that's been playing for 10 years might have better handles, but probably the guy that's 7 foot two, that's pretty athletic and can just palm one ball with one hand, is more likely to actually excel in this kind of thing. So if you come in with the preparation of just having certain skills and luck, you will also succeed in a higher level. So there is no right, there is no wrong, and that's the same thing with trading. If it's always right, 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 right with a high win rate, that is great. But at the end of the day, people will tell you then your strategy is off. You shouldn't be happy about those trades and all those things. So the traders actually either are just so hard on their past selves almost, or there's something up with all those videos online. Because the strategy and stuff, it doesn't really reflect the truth about trading, where it's like one day you had a shitty day and you lost some money and you feel a little not good, and the next day you maybe lost a little bit of money but you're actually feeling somewhat better, and it shouldn't affect every single day, which it usually does. And you start making money, and the days where you start making money, you make a little bit more money and more money and more money, it's actually pretty okay. But it's not only about like success rate. So your idea was today that the market goes up 100 points, you didn't place a trade, and you were correct, so that is phenomenal. Next day, you do it again, and you do it again, and you do it again, and then you start adding things into it. You're like, okay, the market went down 40 points into a drawdown, and then it went up 100 points or 140 points, hit TP, great. So your execution started making sense over time. Sometimes it's okay just to run with the money. Okay, it's up 40 points, I'll take it out. I don't want to lose the rest of it. Totally understand that. Next day, then you make another 30 points. Next day, then you make another 30 points. Now you made 100 points, and that's already your $2,000 for the week. Now you have 5 accounts. That's $10,000 in a single week. Now you're allowed to take out 5,000 of that. Start building those things up. Build a little bit of successes, and it keeps going. And it keeps going. Forward versus backward testing. So back testing validates logic. Forward testing validates execution. Simulation tests discipline. Live trading tests psychology. Each phase has purpose, and skipping steps increases the risk of progression, which then builds the confidence to actually get to the results that you're actually looking for in the long term of trading. And what backtesting reveals: true win rate, average drawdown, losing streaks, best and worst conditions, strengths and weaknesses, emotional pressure points, and strategy limits. Then with the actual forward testing from the back testing, one of the things is there's no emotion involved other than success kind of over time once you figure it out and you rinse with it, and it's so much fun to actually start back testing a lot. You get into it, you're like, okay, this and this and this happens. Now that my Pine editor won't work for 8 hours, so I gotta keep going back to ChatGPT because I don't know how to code. So then you gotta go through that, go into Claude, start doing those correctly. All of a sudden, you have a perfect strategy that you can name yourself, put it on Lux, put it on TradingView. Anyone can use it. Super cool thing. So that's one of those things that one can work on over time with trading as well. And backtesting just is completely one of the best things to do, because you can just learn things over time too from the market just by going through it over hours and stuff. It's just like learning a book you always wanted to learn about, like, I don't know, working on old cars or something like that. Going through those things, or old stories, learning about certain athletes, certain successful people, or just random stories about whatever it is. Cat in the Hat finally found his hat again. Something, whatever is fun to you, you know? Common backtesting mistakes: curve fitting data, ignoring losing periods, cherry picking results, changing rules mid test, using a hindsight bias, testing too few samples, and avoiding uncomfortable results. That's a huge one too. If the uncomfortable result is something like this, you can take your strategy, and what you do with that strategy is you have 15 points, for example, that it has to get you 15 points before it loses 500 points. And all of a sudden you have a win rate of 100%. But then you put it into the calculator for, okay, so every time I won 15 points, that's 500 trades. 500 trades in a row. And you lost one trade, and all of a sudden your percentage just dropped by like 90%. Your win rate is 99%. but that one trade wiped out almost everything because it somehow happened, right? And there's a likelihood that it can happen. So you gotta have like a risk to reward that also is then somewhat knowledgeable enough of that entire chart, create the chart on your own Excel. Super simple. Like if you theoretically have a 3 to 1 R with those things, and you only need like a 50% win rate, then because 3 to 1. So then you're not gonna usually have four in a row that go wrong, but let's say it does. Then you need a 4 to 1 R, but it doesn't even fully matter, right? I personally like higher win rates, but those are actually good to know. And go with those strategies and be like, wow, look how cool this strategy is. Get in love with the trading game, and it will help you out in the long term. Trading rules mid-test, using hindsight bias, testing too few samples, and avoiding uncomfortable results. So those results can be skewed here and there. Backtesting and psychology. Data removes self-doubt. Losses feel normal. Patience increases. Discipline improves. Fear decreases. Confidence becomes grounded. And psychology stabilizes. The institutional view. Institutes test everything. Strategies require statistical approval. Risk is evaluated before deployment. Capital is protected first. Execution follows validation. Data governs decisions. Process creates durability. Of course, like institutes will test through everything and have quants and the most money in the world and have insider information and this, and they can buy a stock like Nvidia buys or Palantir buys a random electric plane stock in the last few weeks, and all of a sudden it goes up another 200% in a matter of a few weeks. And this is a long term hold because they're giving them contracts and Palantir's military, so you get government contracts, so then you get to involve them. All those things then work hand in hand, and that's like a different thing about those entire things. So, kind of crazy how that stuff works, but yeah, they test every single kind of idea, and then those things are just foul play, which is fair play at the end of the day because it's big business. Backtesting is practice. Define strict rules, test across multiple periods, record every trade, measure expectancy, analyze drawdowns, refine only after data, repeat the process. When a strategy is ready, expectancy is positive, drawdown are acceptable, behavior is consistent, rules are followed, confidence is earned, size is scaled slowly, and risk remains controlled. So it's completely your decision on if you want to have a quant style stop loss where you kind of watch the market for 10 hours and you're like, okay, I'll just leave it there and have a solid stop loss, or you run with it until it kind of returns because you know how the strategy kind of works and drawdown can be a part of it. Then you have a break even stop loss sometimes here and there. Personally, one of my struggles is I leave too much money on the table, and that's one of the greatest scalpers also said this. If you have a trade that goes up $6,000 and you break even stop lossing it, or you leave it at a minus 2,000 stop loss, if the market somehow returns in a second, right? Somehow big news, crazy IFVG thing happens from new open hours, maybe a big macro event happens, midnight occurred, something random, and you lose then that 6,000 and you go down to minus 2,000. That's actually a loss of 8K rather than marking it out at 4,000 profit and then not accepting another 6,000 in profit if it would have gone your way, right? Taking partials is also a plausibility, but generally just to be in green is always very important. But losing that much kind of also personally, my psychology ruins my own psychology way more than having one shitty trade where I just lose $1,000 instantly. If it goes all the way up and then I'm like up that much money and then I lose, or I pull it out too early, those are ones that I'm like kind of mad about sometimes. But it can't ruin a day. You know, it's one trade where you still are profitable, or maybe not, and it should be okay. So the key takeaways of this chapter are that data replaces beliefs, backtesting is respected for capital, sample size matters a lot, professionals demand validation, and trust is earned. The reason why sample size is so important is because we're playing a game of probability. And let's say that you toss a coin and instead of heads and tails 50-50, you know that you have an 80% win rate on a 1 to 1. You'd probably take that heads instead of tails with a higher likelihood every single time. So that's why the sample size is so important. Because if it's only 4 trades, that's 80% to 20. that means 4 times you got it like that, and then you got 1 time you got heads, right? But if you toss that coin 1 million times and it's the 80 to 20%, then now slowly there's something of the market that you have to kind of use that edge and use it in your own way to accept that there might be a higher niche aspect to it. So yeah, that was backtesting and why we respect it. If you have any questions, leave them in the comments. I hope that made sense. God bless you guys and peace out.